If you're looking to buy a home today, I know you've heard about the high interest rates, but it's not about the interest rate, it's about the payment. So today, I'm going to tell you how you can get that payment down for a period of time, even in the current interest rate environment. This is Jeff Grebe, and before I do, please hit the subscribe button and click the bell to be notified of new videos from this channel. Now, the interest rates are hovering around 6.5% range, and these higher rates are adding hundreds and even thousands of dollars to monthly housing costs for new buyers. Yet, buyers who feel trapped into paying higher interest should know that there's a way to lower your monthly mortgage payment with a mortgage rate buy-down. True to its name, a mortgage rate buy-down is where money is paid up front to buy the interest rate down for a certain period of time. This, in turn, will reduce your monthly mortgage payment, at least temporarily, so the buyers can ease into the housing cost, or down the line, they can refinance when the rates drop. Best of all, the buyers don't even have to pay for this buy down. That's right. In the current market, there are sellers and builders, sometimes even lenders, that are willing to pay the money to buy down your rate. So home buyers might be happy to hear that there's a free runaround around high interest rates, but you also might wonder, is there a catch? So to help you decide, we're going to go through what a mortgage rate buy down is, talk about the pros and the cons, and how to decide if getting one is right for you. So why the mortgage rate buy down is popular today. The rate buy down was once popular during the interest rate high era of the 1970s. So it's understandable that it's resurged in this current rate environment. While this clearly seems to be a win for home buyers, sellers and builders can find that it will benefit them as well, since offering to pay for the buy down can help close the deal. With increasing interest rates, sellers will likely be looking for ways to incentivize buyers, and this program will be a great way to do that, and it's often more favorable than a price reduction. So even lenders, many of whom are scrambling in this business to try to find ways to nab the borrower, might be willing to pay for a buy down themselves. Or there are many lenders, as in the case of our preferred lender, that will offer a future free refinance. So home buyers who aren't offered the buy down up front, you can always ask for it in negotiation. So in lieu of a price reduction, you're asking for them to pay money to where you can buy down the rate. So let's look at how mortgage rate buy down works. In a nutshell, a buy down offers homebuyers lower monthly payments for a set period of time, typically 1 to 3 years. After that point, the interest rate returns to the original fixed rate. A buy down comes in various forms in order to suit the buyer's circumstances, and here are some of the most common ones today. So here's the types of buy downs. You've got a 2-1 buy down. So a 2-1 buy down means that during the first year of your mortgage, the interest rate will be 2% below the fixed rate. In the second year, it'll be 1% lower. Here's the gist of how that will pay out with a 30-year fixed mortgage on a $300,000 house with a 5% down payment and a 7% rate. In year one, the rate is 5%, and the monthly mortgage is $1,529.94. That's an annual savings of $4,394. In year two, the rate goes to 6%, and the monthly mortgage payment is $1,708. The yearly savings on that is $2,248.72. And then in year three, the interest rate goes to 7%, and the payment is $1,896. And it remains fixed at that 7% for the remainder of the 30-year period. So the total savings for the entire amount of the loan is $6,642. But you can always refinance. So if by the third year the interest rates have come down to in the 5% range, you can refinance and you can then fix it in at the lower rate at the time. That's why we say you should date the rate but marry the house. So you got to find a house, but you got to deal with the rates right now. Now there's another way to do it in a buy down. It's called a 3-2-1 buy down. So this temporarily lowers the interest rate for the first 3 years. The first year is 3% below the fixed rate, then 2%, then 1% below, and then the final fixed rate for the remainder of the 30-year period. So this is how this would look on a $300,000 house with 5% down and an interest rate of 7% for a 30-year fixed mortgage. In year one, the rate is only 4%, and the monthly mortgage is $1,360.63. The annual savings that year, $6,424.74. In year two, the interest rate's 5%, and the monthly mortgage is $1,529.94. That's an annual savings of $4,394.05. Year three, the interest rate is 6%. The monthly mortgage is $1,708.72. The annual savings, $2,248.72. And then in years 4 through 30, you go back to the 7% rate, and the mortgage is $1,896.11. So the total savings of the life of this loan for this buy down, $13,068.51. Now remember, by the time you get to that fourth year where it goes to 7%, maybe the fixed rates have gone down well below 7%. You can refinance. And as I said, there are some lenders out there that are offering free refinance programs under certain conditions. So be sure to look for that. So how much does a mortgage rate buy down cost? Since a mortgage rate buy down is essentially prepaid interest, the fee of the buy down, which can be paid by the seller, the builder, or the lender, will be equal to the amount of the saved interest. So for example, the 3-2-1 buy down we talked about a moment ago, the interest savings was $13,068.51. That would be the upfront cost paid by the seller, the builder, or negotiated into the contract. So in the above scenario, you can see how that works. This sum is then placed into an escrow account, and it helps supplement the buyer's monthly mortgage payments over the length of the buy down. So while buy downs might seem like a bum deal for sellers or builders, it's often better than them not being able to sell a property at all, and it's also better for the lender to land the loan and instead of potentially losing that customer. So while a seller or builder could reduce the price of the property, some might prefer to keep the sales price higher and foot the bill of the buy down instead. So in this sense, a buy down can benefit the buyer, the seller, the lender by drumming up deals that they might not otherwise have. So I'm representing a builder right now. We're offering a 1-1 buy down. So 1-1 buy down is buying down the rate 1% for the first 2 years of the mortgage. So if it's a 6.5% fixed rate, the first 2 years are going to be 5.5%. So here are the pros and cons of a mortgage rate buy down for buyers. The mortgage rate buy down benefits buyers today in that they can slowly ratchet up to making higher monthly payments and save money during the low interest terms. The main risk of a buy down is that you'll grow accustomed to spending the money you're saving. Isn't that how we always do? And you'll end up having trouble making the monthly payment when you eventually need to pay the full interest rate. So you will have to actually qualify for the ultimate full interest rate payment. So you should theoretically, financially, be able to afford that higher payment. But you need to be preparing for that when you're in the lower rate years. That being said, lenders qualify borrowers according to their ability to pay back the loan using the higher rate, as I said. So they still want to make sure you can truly afford it in the long term. You might have also heard of adjustable rate mortgages. So what about a buy down versus an adjustable rate mortgage? Which one is better? Homebuyers contemplating buy downs might wonder how it compares with other loans that offer temporary break in interest, like what's referred to as the ARM. While the ARM does offer a lower interest rate for a certain period of time, typically 5 years, after that point, the rate could shoot up each year. making it more unpredictable, and you might want to avoid that risk. A rate buy down, in contrast, allows the buyers to still get the fixed rate mortgage ultimately that they would have got for that 30-year period. So an ARM might make more sense for home buyers who know that they're going to be in that house for a short period of time before that rate starts to adjust. But those who plan to stay beyond that initial 3 to 5 year period, the buy down might be a better option for them. The bottom line is that you have options, and it's really about the mortgage payment. And there are ways to help make that payment more affordable in the short term, and down the road, maybe you refinance. The key is to get connected with a good lender, and we can help you with that here at Weichert Realtors Advantage Plus. You can reach out to us at 865-474-7100 or online at AdvantagePlusTN.com. We can connect you with our preferred lender. Right now, they're offering free refinance. So if you get a mortgage right now and a year from now, the mortgage rates go down, you can refinance with them for free. Of course, there's some terms that apply, so they'll be happy to talk to you about those. I've enjoyed talking to you. There are ways to get you in a great home at a great price and a great mortgage payment, guaranteed to be less than what you might be paying in rent right now. Thanks for watching, and click to get the Summer's Buyer Guide, which will share you more information about buying a home in today's market.